Hello and welcome, everyone. Thank you so much for joining us for this month's State of Freight webinar presented by Fleet Owl. My name is Julia Becker. I'm the Vice President of Media Operations here at FreightWaves, and I'll be your host for today. I'm joined in the studio, as always, by FreightWaves founder and CEO Craig Fuller and SONAR's Head of Freight Market Intelligence, Zach Strickland. Today's conversation will cover the latest insights from SONAR, current market trends, and insights from our experts. Craig and Zach will also be answering your questions live during our discussion today. But before we get started, I want to cover just a couple of quick items. First, if you have any questions during our chat today, you can reach out to our team via that Q&A box in your console, and we'll save those questions for the end. If you have any issues during our webinar, you can reach out to me via that audience chat function in your webinar platform, and I'll reach out to help you troubleshoot. We'll also be sending a link to the recording of this webinar tomorrow via the email that you registered with, in case you want to watch it on demand or share it with your colleagues. Now with that, I'll go ahead and turn it over to Zach to kick us off. Zach, let's jump right in.
All right, thank you for that, Julia, and thank you for tuning into this month's State of Freight, and it is a spicy month of February, Craig Fuller.
It's super hot in February.
Hot in February.
By the way, I want to do a shout out to Fleet Owl. They have the best looking logo mascot of any sponsor we ever had on State of Freight.
I love owls.
I love owls.
Yeah.
Owls. Look at that thing. Can we pull that up again? Let's give them a shout out. I like that owl. I want to. You know what we need is a stuffed owl here to like look over all this data that's happening in the freight market.
I mean, it's the symbol of wisdom. I mean, Athena's
a ton of
mascot.
stuff happening.
Yeah. I mean, they use the owl, and man, have you ever seen an owl running on the ground?
I've seen it in show.
It's insane. It's a little creepy,
cool.
But we like that owl for sure. Thank you to Fleet Owl. But Craig, let's get into the market here, because I think, you know, you and I talk to a ton of people. You have your own audience. I have my audience. I think they're saying basically the same thing for the most part. A little bit of dissonance on the reasons why this market is so what it is.
There is no disagreement that this is a very different market today. The question, I think the big disagreement is why and how, and is it sustainable? And I think there's been a lot of debate. A lot of it's taking place on X and LinkedIn, and there's a lot of opinion. I think if you go back, it was very clear in mid-January when we had Fern, that last week of January, there was this winter event. I think a lot of people recognized that was going to be disruptive. And I think a lot of folks said, naturally, you would see high rejection rates. Naturally, you would see tighter conditions. And there was an expectation that was a one-time weather event. And then even as early or as late as last week, people were still arguing that, well, maybe this is the backlog of weather disruptions. As we get further and further into the calendar, it is becoming increasingly obvious to, I think, many people that the weather narrative, it just isn't real. This is a catalyst that perhaps weather was a catalyst in itself, but it was already taking a very tight market. I was talking to a very large company in our space, you know, top three player, that told me, is like, look, remember, we had a weather event last year. It wasn't maybe earlier, but it happened. We've had weather every year. Weather's disruptive, but the market does not respond the way it has been. And you know, even when you go back to 2021, where we had that big Texas storm that caused I think we would have forgotten about the Texas storm. It hadn't been for all the.
Well, everybody's kind of washed over it because it happened during COVID.
But it happened in COVID, which was already a tight market.
Yeah.
It was already a market that was clearly stressed. There was already a lot of demand. There was already capacity tightness. And what that did was it just created a catalyst for 2021. And we really didn't recover the market did not cool in terms of capacity until 2022.
Right.
The same thing is happening now. We had this weather event with Fern earlier, really took place the third week in January. And now we're in a situation where the market has not gone back to where it was before. It is still very, very tight. And there's some interesting data points. I try to keep a lot of the more, call it difficult data to understand. Like everything that I do tends to be, how fast can I communicate this?
Right.
on a tweet. Like the stuff that I tend to focus on is stuff that I can explain very easily to a layperson on how this stuff works. But there's a ton of data behind the scenes that we use to actually provide more affirmatory analysis. And we should talk about those things today.
Absolutely. So let's show them the chart here of tender rejection rates. And I think this is the first layer of making your point about how conditions were already tight. Like tender rejection rates, of course, the rate at which carriers are turning down load requests from their customers, mind you. These are their long-term customers. And in the conditions that we've been in over the last several years, you can see a rejection rate averaging below 5% for the majority of that 3-year period before 2026, outside of some holiday spikes.
And you can even see we have new, inside of SONAR, we now have the current and the averages up there at the top. You can actually see it. The new screens will calculate that for you if you're.
But if you look at this chart, you see that the white line was fairly elevated, which is the current year, over the yellow line already.
It was already, we came in, I mean, if you go back to the yellow line, which was the end of 2025, it followed a seasonal, we've seen in 24, we had a seasonal surge, which was post-election, and this is when I got very bullish, perhaps prematurely, volumes collapsed due to the Liberation Day tariffs. You go to 25, we came in with a very strong market. We got 13% rejection rates in December. I remember looking at it, it was the week before Thanksgiving. We saw this massive volume increase happen in the freight market that had taken a pretty depressed freight market from a volume standpoint and brought a lot of new activity. A lot of it was retail. We have the data, that we were able to determine that. The stuff that I think is really interesting is we came in with a real strong market earlier this year. That dip that you see right there is both the weather dip, but it's also the end of the week related to MLK Day. That was a holiday week when it dipped and then rebounded. And so the market was naturally, that's when a lot of drivers came out into the market from the holidays. They waited until that date. They came in, the Fern hits, and it's not cooled down since.
And I think, I'm gonna call out Harvey here because Harvey gets a lot of the blame or credit for the 2017 market kind of inversion that we had.
It was August of 17.
But I would argue, having been in the space and being in a carrier mindset at that point in time, there was a long protracted freight recession in 2016. It was an industrial-driven recession, and not a retail one.
It was really a 15. It was 14.
15,
oil prices, WTI was $140 a barrel, collapsed in 15. There was an industrial recession. Oil hit $26 a barrel in January, or early January that year of 16. And the freight market, that was sort of the bottom, 16 was sort of the bottom of the market, and it was recovering. This is before FreightWaves, so we don't have historical data on this particular data points, but you can go back to public earnings, and you could see that the market was certainly healing. And then the catalyst, as you said, the prime situation was there. It was like lighting a match. And you had this, it's sort of like throwing gasoline on a fire. Imagine a bonfire, and you sort of built your bonfire. All of the kindling is there. It's ready to go.
And you're just piling pine straw.
You're just waiting for that guy to be like, I'm going all in. And he throws the gasoline, and then it goes all out of control. And then the thing just burns. Burns for days. What we're seeing right now is exactly what you've said. And the fact that this is taking place in mid-February, the fact that this is after Valentine's Day, there's no market catalyst in terms of demand, is the strongest sign. And we are 3 weeks past the big weather event. We had Fern, and then we had that East Coast weather event that really was not in high freight concentrated markets. In my in-laws, I think it was like negative something. Wind chill was like negative 20 in New Jersey or something insane like that. It was a week after Fern. But all of that major weather last week and this week has been I know we got some West Coast stuff happening, but this is one of the cleanest weeks in terms of weather. And we are well beyond that. And what we're seeing right now, Zach, is we're right at 14% rejection rates. And this is telling us that this market is really prime for a breakout in mid-February. Like we are in one of the weakest months of the year. There's nothing happens in February.
Historically, the weakest month of the year.
And especially the second half of it. Because what you get is you get a little bit of activity for Super Bowl.
Yeah.
You get a little bit of activity for Valentine's Day. And there's really from mid-February to really early March, nothing interesting happens in freight. You might as well just.
Kevin Hill and I used to joke about cat memes in January and February. That's what
January benefits from back sort of returns, gift card season, tax refund season. It takes place in the last week of January. But what we're seeing right now is a really, I think, interesting set of conditions that is unlike anything we've seen in years.
I think too.
And nobody wants to believe it. Here's the crazy part: is like,
well, we've done this before.
We have done this before. We've seen, FreightWaves, because of the high frequency nature of our data, is going to see developments, and there have been green shoots, and we've been wrong.
I would have argued that
we have been wrong. This is, I think we got excited. I got excited in November of 24. This is a very different set of conditions.
Absolutely. This is not a demand-driven situation, which I think is what's hard.
It is not a demand-driven situation, but there is some demand that's slowly catching fire.
There is a little bit of demand.
If you look at the map of where we're seeing the activity take place in terms of the actual map, you can see that this is happening in a lot of the industrial parts of the economy. In fact, the ISM data, look at this. Look at this map. And if it were, this is the outbound tender rejection, a little bit of clarity on here because we have two rejection indexes. They for the most part, can we pull up this, Zach, where it's the two rejection indexes? I don't know if we have it on here. I posted this on X short ago. And basically, what I want to show, let's see if the folks in the back can find it. They don't have it. Let's just let's go back to the outbound tender, not the weighted rejection. We're confusing our audience. But the STRI index and the OTRI index are two separate indexes that do the same thing coming from two different data sources. STRI actually takes the OTRI data, but it expands it largely into food and CPG as a large piece of that data set. And they tend to follow each other quite closely because there is part of the formula is that OTRI is in it, but also because market tends to do it. But something very interesting, I don't know if the guys in the back can find this chart because I posted it on X, but what is happening right now is OTRI, which tends to be manufacturing and retail, non-CPG, non-gross retail, is firming stronger than STRI, which tends to have a lot of food and CPG in it. And it tells me, this is it right here, pull that up. Get that puppy up on there on screen. I want to show you this. This is the most exciting market we have seen in years. Those two indexes, what we're seeing is that STRI is starting to cool a bit, very softly, because it has a lot of reefer and it has a lot of regional freight.
Right.
OTRI, which is manufacturing and a lot of long haul retail, is firming in rejections. And that, you know what that tells me, Zach? Is that the recovery we're seeing is starting to show up in manufacturing. And if you look at the map, let's pull up the map of where the rejections are taking place. What I think is incredibly interesting about this particular map is it's in the Midwest. And Julie Vandekamp, who we have a SONAR Captain's Club meeting, which is our top customers that are a part of it, both logistics companies as well as shippers. And some of the shipper comments, as I understand, was the fact that the tightnesses in the Midwest is very unusual. And the reason that's unusual is it's not happening on the coastal cities. We're not seeing it at the ports, which we did over the last couple of years. We saw a lot of, when the market tightened, it was on the ports. It's happening in the Midwest. It's happening in the industrial Rust Belt part of our economy. It is industrial machinery. Look at Texas. Look at West Texas. What takes place in West Texas? That's oil and gas. That is oil and gas. You've got industrial machinery. You have the Rust Belt coming on. You've got a lot of auto. Interesting enough, we were looking at what happened in Minnesota. I think you and I had this question. Folks that are closer to some of the manufacturing and industrial segments said a lot of the data center build out, a lot of the machinery that's coming from for data centers, a lot of the auto and EV stuff, the batteries, a lot of that like heavy equipment that goes into the auto sector is starting to come alive. Aircraft parts out of like Kansas City, John Deere tractors, Caterpillar, IBM. This is all in the Midwest.
Yeah.
And we have not seen the Midwest perform in years. When was the last time we saw a map like this, Zach, where it was the industrial segment of the economy? The Midwest was performing when the West Coast was not. When have you seen that? I can't remember the last time that ever happened.
So I have a chart that will tell us how wild this swing is.
Hold on a second. Before we leave there, 40% rejection rates in freaking Iowa.
Yes.
Like, that doesn't happen.
It's a freight manufacturing
But think about it. It's Fort Worth, Texas.
Yeah.
Big auto plant down there. They build a lot of those Denali's and GMCs down there. You've got Kansas City, big auto plant. You've got Detroit, Michigan, big auto plant. Chicago, Toledo. It is an industrial renaissance, and it's starting to show up in the data. The industrials did not participate last year, and the industrials haven't participated in 3 years.
Well, we did have the ISM come out.
ISM had one of its strongest readings it's had in years.
Right. So the new orders component specifically popped in January.
And transportation is a very volatile number, which is aircraft, but it's also like heavy machinery.
Right.
It was both transportation and non-transportation. But like, look right here. Let's go to the charts.
Yeah. So this is a chart of regional rejection rates, and you can see this flip in the Midwest. So the Midwest.
What is URWT, by the way?
So West Coast is WT. URWT. That's the orange line at the very bottom of the chart. That is your West. That's your California, Arizona, Nevada. And then you've got the Midwest, which is the largest freight region, which is, again, a highly unusual situation when you have.
Relative to our data.
Yeah.
If you went back in the old day when I was, and you and I were both on the floor, if you will.
Right.
The Midwest was the heartbeat of freight. It was the South and the Midwest, but it was really the Midwest that was pumping the freight. And that has really, since we've had FreightWaves here, the Midwest has been a relatively non-participant.
And the fact that
if the coastal cities were.
But look at the spread here, Craig.
What is
between
URNE?
the Midwest.
Is that Northeast?
Yeah, Northeast, and then which is going to be exactly what it sounds like. And then you've got West Coast and Southwest. Southwest is going to be your Texas. But a lot of our regions are grouped together in that 11 to 13%-ish.
So the
range.
Northeast is on fire. Right?
The Northeast is crazy to have a rejection rate this high.
I'm reading the chart wrong. Sorry, I've not seen this chart ever. By the way.
So
the Midwest region is the stuff that's on fire.
The disparity, I wrote about this in the Daily Watch a few months ago, and I thought the spread was really wide then, but normally all of these regional rejection rates kind of clump together.
Yeah.
The spread between, the difference between Midwest rejections and West Coast rejections, I get it, we're out of season for the West Coast right now, but it is absolutely crazy to have this type of spread between two regions in our data.
It's insane.
Yeah.
And the fact that the coastal cities, if you go back to really, since FreightWaves was born in 2017, we entered when the first set of trade wars started. The coastal cities, particularly the West Coast, somewhat the East Coast, but certainly the West Coast, has been driving the predominance of the market.
Yeah.
I don't remember, and maybe, we've been doing this for now almost 10 years. Do you remember a time in any of our data where we saw the Midwest pop that we did not see the West Coast pop?
We've been in this weird West Coast era of volatility. COVID was really, like if I showed this chart from 2021, West Coast would be where the Midwest is. Now, the Midwest wouldn't be as suppressed as the West Coast is today, but this is clearly not derivative of import behavior.
It's not import behavior. There's a couple of things that we have to be very clear. We're talking rejection index.
Yeah, rejections.
So we're not talking specifically demand.
Right.
We're talking about capacity.
Good clarification.
And a lot of the Midwest capacity has been these immigrant fleets in Chicago, the Chicagoland. A lot of it has been fleets that the administration is coming after. And that is a lot of what's happening. One of the other things that's happening, and one of the reasons that, at least my read on it, is that there are folks that are getting different reads in the data, particularly if you're using load board data, is that the larger shippers are actually pulling freight away from the smaller brokers right now. I'm hearing it from the largest brokers, is that either the brokers are giving freight back and they're going to the biggest players because they trust them, or the brokers are giving the freight back to the shipper because they can't make money, and they're saying, "Hey, big top three broker, take this freight." I'm hearing that, But I think also there's a comfort level. There is a comfort level that a large shipper has. And I think what's happening is a lot of the sort of load board freight is now showing up with carrier direct freight, shipper carrier direct, because I think they're getting priorities in the routing guide. If I'm a shipper, I have much more comfort of knowing that the carrier, if something happens to that load, that there is a carrier behind it than I do with some of the smaller brokers that are out there. So there is some element of why we're seeing some data developments that are different than some of the other narratives.
You're hitting on an extremely important point. I think we need to dive into a little bit here because I get this all the time. This nuance between broker and carrier contract spot freight. So the chart that I want to pull up here is going to be our contract rates versus our spot rates. And the reason I think that we see a lot of these smaller brokerages turn this freight back over, if you will, is because a lot of what brokers look at is this green line in terms of rates. They've been looking at rates from the pure perspective of spot market.
Margin. I talk to a lot of very large, say, top 10 broker CEOs. And I do it on a pretty regular basis. And I asked him, how's business? And it's interesting. I said, how's the market? And I did this last night with one of a couple of them, but certainly one. And he goes, not great. And I said, well, why is that? And he said, it's been hard to find trucks cheap. And I was like, I asked you about the market. I didn't ask you about your margins. I asked about the market. And he goes, oh, it's great. Like volumes are popping. Demand is there. Like, it is in some of the stuff I was hearing from some of these anecdotes just in the last week has given me so much conviction on what we're seeing in the market. And it's like it was a top 5 broker told me that the volume of truckload was up more than 20% for their business in a year-over-year basis. And this is not acquisition. This was business that they had acquired. And this broker specifically has a lot of non-large, they do a lot in the SMB market, is where they play, but they've seen a significant surge in truckload demand, which I think was pretty incredible. I talked to a very large asset carrier that told me that this is the hardest recruiting environment in their more than 50-year period. And this is not a guy with 100 trucks. We're talking a very large, very dominant asset carrier that is well regarded among drivers. I mean, there's some that you're like, oh, they of course are having problems. But I'm talking about one of those. I'm talking about ones that is well loved and well respected, that you rarely hear any controversy over. They said it's the hardest recruiting environment in their history. And if you think about this may not be as obvious to those that haven't been on the asset side, but really the gateway drug for new operators, if you think about new capacity, and I'm not talking about before the non-domiciled CDLs and some of the riffraff that we've talked about. Ignore that. But the traditional market was a driver would go from being a driver employee, working for a carrier, he would hire on. At some point, he would want to become an independent contractor, but he would still stay on as a leased-on operator under, my case was U.S. Express's authority. And then, if he had enough confidence, he would then go start his own fleet. That was sort of like the trajectory that how it is. When you cut off the independent contractors, because the company I was talking to has a lot of independent contractors. When you cut off the independent contractors that are under their authority, and they can't find that readily, and it's very difficult, that means that we're not getting new capacity added in. And it means that this sustainability of this market is quite good. And the reasons that they made this comment was that a lot of the carriers haven't been making money, so they haven't been maintaining the trucks. They're very trucks are very old, very, very tired. They haven't been buying new trucks. There's not a lot out there. And there's a lot of competition for all of this capacity right now. And I just think that's another sign about how sustainable this rally is.
Yeah, I mean, also the fact that you have the smaller operators who are getting business, right? Now that they're actually getting calls instead of having to go and
the legit operators are. And I think one of the things we're seeing, you have these fraud tools like Highway and RMIS and Genlogs have come out and search carriers. Like you have some new technology that didn't exist 5 years ago that are forcing screening. And I'm hearing this, that shippers in their RFPs in this round of bids are asking brokers, talk about your non-domiciled CDL process. Do you have a way to screen out carriers? Talk about your compliance processes. Talk about your fraud mitigation solutions. What is your process for ensuring that my freight stays safe?
Right.
And eliminating the double brokering that's also there. So shippers are taking a much more active role that they haven't, and they have the tools now, these companies have the tools, that is filtering out a lot of the bad actors out of the business. And those bad actors aren't getting freight. So we're seeing a rally in contract rates.
We're starting to see the front edge of a contract rate rally.
And it's starting to show up. We're seeing that margin
But
happen.
look at the green line. We've talked about this before. I want people to see that anybody that was negotiating with spot rates only or looking at only spot rates, those have been crawling off the floor since May of 2023 when our rejection.
It was May of 23 was the low of the market, and this is also tender data was at 2.5%.
Same thing.
It has been following it, and that's why the route. But the problem is and look, maybe we are as responsible, or I am as responsible as anybody of getting excited. We got excited in November of 24. See that big increase?
Yep.
Spot rates were surging. What we didn't anticipate was the Liberation Day tariffs that took a lot of steam out of the economy. The industrial economy really took a year off last year.
Yeah.
And it was inevitably it's gonna come back. Like it just is. The U.S. economy is the type of economy that these down cycles don't stay gone forever. Like it is still the strongest economy in the world. Like it's gonna recover. It's a cyclical environment. We had a pretty significant industrial recession over the last couple of years. That appears to be coming near the end. And it's this environment has been building, like you said, since May of 23. It's hard because we doing this every single day, you and I do, or once a month that we do.
Yeah.
It's easy to get excited about these short-term developments. But if you think about it on this very long trajectory, the bottom of the freight market was in May of 23.
But look at what contract rates do for that period.
They're very slow.
They are so slow.
They're very slow.
And that's the way a contract rate should be, mind you, like very flat, not a lot of volatility in it. If there's volatility in your contract rates, that's not normal. Spot market rates, absolutely. We see these like little pulsations over time.
I want to point something out.
Yeah.
Chris Pickett, who was the original writer of the Coyote Curve, when he had put out a piece, Henry Byers posted it, that he goes, "You're not bullish enough," was the headline. Henry Byers' tweet. And he had talked about the fact that he believes that we could see 20 to 30% rate increases by the end of the year.
Absolutely.
And I've been telling people, I think it's fair to say that 10%, if you look at bids from early in the year to later in the year, I think it's at least 10% swing, which seems like a huge number, and it is in a typical year.
And it probably won't happen in one single swing.
We're off 30%.
Yeah.
We are. If you go back and look at contract, which is the shaded white line, we were right at $3 a mile. We're at $2.44. If you think about that, from how much we have given up, carriers and their costs have continued to increase. They're going to try to claw back as much of that as possible. I had a CEO of a top 10 mega truckload carrier maybe a week ago, 2 weeks ago, sent me a text and goes, "Something's happening in the market." He goes, "I'm getting 5% rate increases, but that's just the start." And he's like, "There is something definitely happening in the market." And I think this is exactly where we want to be.
Well, we've made fun of contract rates as paper rates, at times.
Well, brokers make fun of it, but if you're an asset carrier, that is your life.
Yeah, and I think that's...
They're not contracted is the joke.
Right. But carriers do not like to increase rates. It makes them very nervous. I was a pricing analyst. You don't want to increase your rates to risk losing business over time.
They love to increase
they like
the
to
rate,
increase the rate.
but only after they have absolute
evidence.
Conviction.
Yeah.
Evidence drives conviction, but they need conviction that this rally is sustainable.
Yeah.
And I think that's why they've been very apprehensive because they're like, okay, we need to get through the holidays. And I remember when we started to see the activity, it was an unusual set of activity that happened in, I think it was early October. And I remember looking at tender rejections weren't budging. They were very gradually moving, but spot rates were surging off the bottom. And you can actually see it here on the chart. If you go back to where we were in sort of October, that where that started, the increase was happening pretty significantly and sharply.
And that was early.
It was early,
yeah.
But it was, and so there was a question of like, what is causing that? And it appeared that the compliance stuff was actually taking hold.
Yeah.
But nobody wanted to believe it.
Right.
Because it's like, well, I see this stuff. I see the administration acting on it. Is this immigration story that big of a deal? Is it really as big as you say it is? Or is this just noise? And I think what has happened is they needed to get through that to know it's sustainable. They needed to get through the holidays to know it's sustainable. They needed to get through the weather to know it's sustainable. Now we're in a period of calmness where we are well beyond these sort of situational deals. Now, who knows? Iran, all bets are off in terms of what's happening with Iran. That could certainly sap everything we're saying. And I should go ahead and qualify that anything that happens geopolitically could absolutely disrupt this market. There is a bullish argument, not that I hope there's a war, like I'm not a warmonger, although I am a proud American and like to know that we kick ass and take names when we go into places. Nobody wants to get into an Afghanistan issue, but if there is a military conflict that takes place, that is actually strong for the manufacturing industrial segment of the economy. The U.S. freight economy actually does well when there is a military issue. I'm not saying that you want that to happen, but in past wars, that has, as what is triggered, like there was a recession right after September 11, there was a massive impact to the U.S. economy. It was the actual Iraq war and the Afghan war that actually brought us out of that and brought us into 2003, which was one of the greatest freight markets we've had. It does drive a lot of industrial activity.
Yeah, absolutely. It does, but obviously we don't want
a long, protracted war. And we certainly
like,
don't want one.
You look at what's happened in Russia. Now there's and obviously I'm not trying to compare us to Russia, but their economy is now addicted to the war.
Well, it's because of the amount of money.
Yeah.
I think it's a very different thing. But look, I want to I don't want to go too deep into that because I think that's a distraction. But that could certainly disrupt things. Oil prices have been rallying due to reports that I read that Iran had shut the Strait of Hormuz down and stuff. And so all of that is a factor in what could happen. But as it relates to capacity map and trucking, is well beyond
absolutely
having overserved. There doesn't appear, Zach, I don't see any catalyst to bring new truck drivers into the market.
I think that's the second part of the capacity situation that we need to delve into a little bit, because obviously, a lot of the economics of trucking over the last 3 years have been very depressed and not supportive or sustainable for the amount of capacity that has been available.
It's been an endless glut of new entrants.
And part of that has been driven by, the fact that here's the net revocations chart that I want to pull up here. A lot of this fluff, if you will, this is the rate, basically like operating authorities basically expiring, people not renewing or self-reporting that they are no longer going to be active.
We don't have insurance policies, too.
No insurance policies, et cetera. And we have been consistently high. If you look at the very beginning of this chart, people didn't leave the market on this level. I wish I had pulled it out even further, because then you would see the pre-pandemic norm, which was roughly 400-ish net revocations in a down market. In 2019, we had an average of about 500 to 600 net revocations. We've been averaging above 1,000 of net revocations.
There's a ton of capacity. You had the ELD, the English language proficiency. Can you pull that up?
Yeah.
The ELP mandate and out of service chart on here, because I think it's a really interesting chart to show. There it is.
Yeah.
We're about 90.
There it is.
Carriers a day, or 90 drivers that are put out of service a day. If you think about that over 365, because this is daily data, we're talking, something like 30,000 drivers over the course of a year, which, in a market as big as trucking, that may not be, that is a number, but that is still a sizable number. But what you're also hearing is what isn't taking place in terms of English language proficiency is there's a lot of people who are not coming into our industry because they don't feel welcome,
right?
Or they think that ICE is going to show up at the truck stop, or they are afraid to get pulled over and detained. In fact, I had heard last night, I had a source tell me that the ICE is going to truck stops around the country and basically in Sprinter vans and going to the truck stops and detaining, arresting drivers that are non-compliant.
Right.
So the source said that in the 2-hour period, they got 30 truck drivers that were non-compliant at a period of truck stops in the Midwest. And that message is going to continue. And I've said this for a while, is regardless of whether you are support the administration's crackdown on immigration or you think it's deplorable, like regardless of where you're on that spectrum, and I get that, people have different perspectives. We're not going to see a lot of protests at truck stops. ICE is not going into their communities.
No.
There isn't a lot of sympathy for the people that have been protesting about truck drivers being arrested. There just isn't. It's such a disconnected part of most people's reality. And so it's also, you can argue the safety element, you can argue all sorts of things. The administration actually has the high ground when it comes to immigration enforcement in trucking that they won't have in other sectors. Seeing people being pulled out of their homes with young children is hard to watch. But when you're looking at it from truck stops, there isn't a lot of
Well, it's the same mechanism that allows for nuclear verdicts.
It's exactly right. And look, there is a lot of safety and compliance issues that go on. And I think anyone who's been in trucking knows that there have been fraud is rampant, security issues are rampant, safety issues are a problem. The economics of trucking have completely been obliterated with a continuous labor supply. All of these things are very positive, and there isn't going to be a lot of noise that's going to come because we're arresting truck drivers.
Right.
It just isn't going to happen. And so it's a very politically safe place for the administration to exercise their immigration policies, whether you like them or not. It's just not going to be, there's not going to be a lot of backlash. And now what you're seeing is a lot of the, call it conservative media, right-wing media, whatever you want to call it, a lot of social justice folks on social media are looking into all this sort of fraud, and trucking is now, Turning Point is doing a documentary that's coming out next week about the trucking fraud that's taking place, the chameleon carriers that are taking place. All of that is going to continue to put more and more pressure and frankly public support towards these immigration crackdowns in trucking.
Yeah, and trucking has historically been an easier area to enter because of the lack of enforcement of regulation.
There's no barriers to entry. It's lack of enforcement. It's the fact that you don't have to have you don't have to have the social skills. You're not interacting. There's no customer service element to it. And you see this in like food service. You see it in hospitality and like hotels. You see it in agriculture. You see it in construction where they're not they don't have to interact with the culture. The difference in food service, the difference in hospitality, and perhaps even construction is that I don't have, like truck drivers when they're over the road, they should be able to read the signs. They should be able to know what actually the rules of the roads are, and they're going into unfamiliar places. If you're going in to make a sandwich at a deli or be a fry cook at McDonald's, once you learn the job, it's the same job. But when you're driving a truck, you're driving through unfamiliar parts, through weather, through systems, through road signage, all that. You should be able to interpret. And I don't think even some of my friends who are very, very on the left spectrum will actually agree that trucking safety should be paramount and have a hard time arguing against those facts. And the reason I say that is important, not as a political statement, more of to know that this crackdown is not going anywhere.
Right.
It is going to continue.
Right. Yeah, I think the ELP chart too shows the trend being higher.
We're at 90. Yeah. We're at 90, and there's more and more pressure on non-dom CDLs and other things, and that's just going to continue to put pressure on the market. Yeah,
and the barrier to entry component of this, I think, is the more important part to focus on, is the fact that, we're losing, this, if you add the math on this is a moving average, by the way, it's not an everyday figure, but it's, you're talking about 3,000-4,000 drivers that have been put out of service. But if you add into the layer of barrier to entry, that now people are no longer viewing trucking as a place that, hey, I can go and hide out.
Well, think about this for a second. So the report that I got last night about ICE going and basically arresting drivers at the truck stop. These guys are under power.
Yeah.
There's a load that has just, dude's been at the truck stop, is now being detained. He's in some detention facility. The load is still at the truck stop.
Right.
If you're a shipper, your freight has no one monitoring it, no one securing it. You hope that you can figure out where that load is at. Hopefully the ELD device and tracking device will do it. But imagine as a shipper. And then Matt Leffler and I are actually going to get into a legal conversation. I have a show called Freight Expectations with Matt Leffler, he's an attorney called the Armchair Attorney, and he likes to talk about a lot of legal issues. And the question that he is going to answer tomorrow is, if you're a shipper and your freight has been, your driver's been detained and your freight is at the truck stop, can you legally break the seal and can you legally get into the cab of the truck? Remember, that is personal property.
Right.
Your freight may be in the trailer, but your personal property, the personal property of that truck belongs to the dude that's now being detained. And the question is, as a shipper, what do you do? And so this is an interesting question on Freight Expectations. I'm teasing it because he's got some legal answers to this. We have some practical answers to this. We're going to dive into it. But what I think is really, really interesting about this conversation is shippers now have to think about who is behind the wheel.
Yeah.
Because if there's a risk of the person being detained, if there's an insurance claim, what if that driver didn't pay, or that fleet didn't pay the insurance? What if the broker doesn't have the ability to recover the freight? These are all questions that you need to, and I think that's going to make it harder and harder for non-compliant carriers to continue to proliferate, because it's going to mean that the freight's going to go to the market. And I'm hearing it from the largest brokers, is they are picking up market share, because the shippers are saying, we can trust that you are doing the job. And if you didn't do your job, big broker, I at least know there's someone that can write me the check.
Right.
I know you're paying your insurance. I know that you can write me the check. And I think that's important if you're a shipper on deciding who you're going to do business with.
I love that you're teasing out like a little bit of industry insider stuff, that the ownership clause in freight transportation.
Well, I love when people talk about the indemnification clauses. They're like, well, but I'm indemnified. Yeah, but the dude has no money.
Right.
Like, great, you're indemnified, but remember, if there's a lawsuit and it's a $10 million lawsuit, and the dude has $10,000, guess what happens to the $9,999,999,000?
Yeah.
You're having to pay it.
Yeah.
Like, your indemnity is not going to protect you.
Oh man, we could again. There's a reason there's a show for that. So I definitely want to make sure we leave time for questions here. We didn't even get to everything that we could have talked about.
I just want to say the ports are just not even a player here right now.
Yeah, but I think there is some information in the ports.
You want to talk about ports?
Okay, real quick, I'll talk about the ports.
You got this chart teased up.
I do. I wanted to at least hit on this a little bit here. We didn't even get to the refrigerated flatbed stuff.
We didn't talk volume either.
We didn't talk volume, but here's a little bit of volume for you. And I think this is an important thing to monitor as the year progresses. The IOTI, the Inbound Ocean TEUs Index. Now, some people are going to look at this chart. We've got a lot of headlines on American Shipper about the volumes being down in the ports. They are down. But what we're talking about here, if you look at the white line, we're significantly down compared to the last 2 years. But we are, of course, this is a Lunar New Year bounce that we're looking at. A lot of the manufacturing shuts down in Asia for the containerized imports this time of year, which just started this past week. Chinese New Year. We're well above where we were in a period where people were drawing inventories down. I would argue, and
there's two other things going on that chart. One is you had the preparation of Donald Trump's election that was happening.
Exactly my point.
And there was a port strike.
There was a lot of reason for people to over-order.
They were ordering to get freight in that caused it to be distorted. So it looks, and that's what drove, if you go back, that's what drove most of the freight market for the first half of last year.
You're reading my mind.
Because manufacturing did not participate.
Yeah.
It was a lot of that import activity did participate. And look, the LMI, I know Zach is a good friend of the show, Freightonomics. The LMI has talked about inventory tightness.
Yeah.
And we're seeing that inventories are at low levels, or have been the last couple of months. They're tightening. And therefore, there's going to have to be a rebuilding. One thing my dad has said, I was talking about this, been doing this for 50 some odd years, and he's like, every single time inventories are low, right after that is when the freight market comes back, because that's what we see. That's how the market works. And so you can expect that to be driving a lot of it. Is the inventory replenishment cycle is a really important cycle, and you have all these other things that are external factors.
I'm an inventory nerd.
I want to tease something before we go.
Okay.
So we're building a brand new studio. Let's pull this puppy up here. We have a brand new show called FreightWaves Today. We're building a brand new studio. Reminds me a lot of like Sports Center, but also like a Bloomberg studio that I've gone into frequently. This is a brand new studio that's going to take place here at Freight Alley, and we are actually going to be taking this show, the State of Freight, your show, Freightonomics, and Bring It Home, which is our reindustrialization show, into this daily show from noon, 12 o'clock Eastern to 2 o'clock every day. SiriusXM has agreed to simulcast it as well, or broadcast it as well. But this is going to be the daily show. You're not going to miss it, because it's going to be what you want to know. It's State of Freight every single day. I'm so excited about it.
When does it start?
So as soon as we get all the equipment that we need to build, it's a beautiful studio, and I want to have it right. So I was hoping April 1st or April 2nd, because you don't do anything on April 1st. But it's probably looking like the estimates now say May, but that's okay.
Okay.
When we do this, you will have freight, economics and State of Freight on a daily basis, and Zach, you're going to be on that. I'm going to be on it. We've got a fantastic lineup. I cannot wait.
Good times. April or May. So State of Freight next month, still on schedule. Julia, let's get some questions and get some answers to these people.
Awesome. We've got a ton of questions, so I'm going to go as quickly as I can. First one here is from Eric. From a large shipper's point of view, how should we read this supply-driven tightness? What does it mean as I'm setting my 2026 transportation budgets and managing risk?
I think prepare for the worst if you're a shipper in terms of resiliency. It's going to get harder and harder. Like, one of two things is going to happen. One is, this is a seasonal, you either believe that the winter thesis and the weather thesis is the right one, and it's going to cool a little bit for the next couple of weeks, and in the second half of the year, we're going to see some firming. Or it's not. I would argue it's not, and I have reasons to believe that it's not going to do that. So that means that you need to prepare that even where you've awarded business to carriers in your RFPs, you have to assume that they may take those bids right now, but they may be calling back in 3 months or 6 months. If the market tightens, like we said, the scenario that could happen, and I believe will, this could be a situation where you're talking about double-digit rate increases by the end of the year, and you should be prepared for that.
Yeah, I mean, I think at this point, even if things settle out as they look like they're trying to do, but very hardly, like, this is not normal.
I don't call that settling out.
It's not settling out at all. It's a plateauing of rejection rates. And we've had 2-3 weeks now since Winter Storm Fern. Like, there's always going to be ripple effects from some of these catalyst events that kind of reverberate. But normally what we see after these events is that it's gradually loosening over time. This is a market that is very indecisive about settling down. So when you're talking about long term, and before Winter Storm Fern hit, we were 9.8% on the S-Tri. This market was already like super fragile and ready to kind of pop. And Fern just kind of was the hammer that did this. So if
let's not forget, we have produce season coming. The West Coast is gonna start picking up. You have gardening season, construction season.
There's all sorts of
beverage season. They aren't even a factor right now.
There's all sorts of reasons to think things are not going to necessarily get sustainably looser. Like the yellow and green and pink lines from the tender rejection chart, you can't plan your year based on those anymore. Even if the market does stabilize a little bit, it's not going to land back down around that 5-6% rejection rate range, which is where it was for a large portion of last year, and we'll forget this over time.
Well, also as carriers get more demand, as they start to see higher rates, more demand, and they're starting to make more money, they're always going to be looking at their customers and saying, who are the customers that did not take care of me in the market lull? Who are the rates that perhaps I had to take freight at such cheap rates? That bottom unprofitable customer, like if you had been a shipper that has been taking advantage of the market, and I think many shippers have, you would expect to get some phone calls.
Yeah.
And I think what I would say is that you should think about the fact that the risk, if you're a shipper, the risks of a truck not showing up are the highest that they've been since COVID.
Yeah.
And you need to plan appropriately by padding your budgets. I would put a 10% into my budget if that, because remember, you don't get to be the shipping executive if you miss your budget by a long yards. I would ask for some real higher budgets this year. And go ahead and tell the CFO that you're expecting market conditions. And if they don't believe you,
use this chart.
Use it. Send them to SONAR.
Yeah.
Get our team on the phone with them to explain that it's not your fault. You don't control it.
We're agnostic in this situation in the way that we know that, like, we just read the data. You know, shipper, broker, carrier.
I would say that I'm excited that the truckers are going to have this round. And the reason I'm excited about it, Zach, is that they are the ones that have been doing the hard work, and they have had a brutal couple of years. And I have always root for the underdog. and I always love seeing, I love seeing Boise State beat Oklahoma. I like seeing the underdog come back, and it's their turn. And I'm excited to see the truckers have an opportunity at the table to make some money.
Yeah, and this is just free market dynamics, and where we're watching a sector that has been so beaten down. So if you're a shipper, you're definitely going to need to budget more in your spend. That's a foregone conclusion. If you don't, you're only setting yourself up for problems. But you also need to get into the weeds and figure out where some of that increase should be taking place.
I think I would also, this is a point when the scale of your partners really matters. And I think the other thing that you should be doing is you look at who your partners are. And small brokers have served you well, and they're loyal to you, and that's great. I would also make sure that I had somebody with some resources. You want to be important enough to where you can pick up the phone and call them, and that's all based on relative size. But in this environment, you also are going to find that it's the companies that have been relying upon the load boards for capacity. It's just going to be hard. They're not going to be able to secure capacity the way that they have in the past couple of years. One of the things that I've been talking to a couple of friends of mine is that there's a whole set of people in shipping departments, in freight brokers, that have never seen an upcycle.
Yeah.
Like, we're 4 years beyond an upcycle. They never saw it.
They just think that it's...
we had the same conversation 4 years ago. No, they'd never seen a down cycle.
Right.
And so a lot of times they're just unprepared.
Yeah, truth. All right, I think we answered that one, hopefully.
The Midwest versus at the ports related to reindustrialization in the U.S. and imports falling. And are they falling?
Well, imports are definitely relative to where they've been, yes. Ports are just not a factor. It is I would argue there's two things driving the Midwest. One is the lack of capacity. A lot of these immigrant fleets were places like Minnesota, places like Illinois, places like Texas. A lot of that industrial section, or that I-35 corridor, is where you see a lot of it. And then I will argue that the industrial segments, particularly auto, Rust Belt manufacturing, machinery, aircraft, those businesses are doing quite well right now relative to where they've been. You can see it in the earnings reports. So some of the big, heavy parts of the agricultural industrial demand, energy industrial demand, all of those things are coming back. And I think that's a real strong thing. Commodity, mining and minerals. It's a lot of what's probably taking place in Texas is a lot of those, when you're drilling for oil, the same equipment is also used for drilling for silver or gold.
And you think about the Midwest. The Midwest is obviously closer to consumption and consumer centers. A lot of that freight.
Big box retail.
Yeah, you've got a lot of these, especially if you're running a leaner inventory environment, you're having to constantly move stuff a little bit more, and it's putting a lot of these carriers who have been kind of reducing their fleet sizes and fleet counts over the last bit in precarious positions as well. So the Midwest, of course, as well, has weather influences beyond all of this. There's that refrigerated temperature control dynamic that has been occurring every single year in the last 2 or 3 years.
Ready to go. I want this map right
here.
Look at where the auto plants are in the United States. There is a high correlation to auto plant and the ecosystem around the auto sector that is highly correlated to that. And remember, the administration under the big, beautiful bill gave some pretty heavy incentives to the auto companies.
I think that's one of the things that can't be ignored. We've got this kind of assumption that there's a lot of incentivization that's going to help spur things that didn't happen last year because the big, beautiful bill did not get put into place.
It wasn't a factor. Yeah. Also, there's the auto, you can write off your buying and purchasing the car. Data center, a lot of what we're seeing is data centers that were concentrated in places like Virginia. A lot of the data center moves have been in the Midwest too. And a lot of the battery and equipment and construction stuff, that this big CapEx boom is actually,
this is the year.
Heavy Midwest.
This is the year for CapEx. The thing that confuses me that I can't quite figure out, we see in the data, industrial production and all that kind of like showing a pretty decent jump in January. But the sentiment is not quite.
I think it takes
supported.
A while for people to believe it, just like it does in our business.
Yeah, and
we are arguably 6 months into the rally.
Yeah.
Like if you think about September and October was the start of the freight rally. There's still some bearish sentiment. I was bearish until like mid-November, until we saw the flip into volumes. I think a lot of that is just people have been. It's been a pretty tough environment, and it's hard to believe it's real.
All right, Julia.
Now, consumer sentiment is a little different.
Yeah, no, I'm not talking about that. I was talking about ISM.
Who asks, is bankruptcy from the rate pressure going to continue to tighten capacity and in turn move rates up?
Is bankruptcy from the rate pressure? Well, truckers, if we're talking trucking bankruptcies, truckers benefit from higher rates, but balance sheets have memories.
Yeah.
And there has been a long journey of some really abysmal conditions. And the sins are starting to pile up. One of the interesting things, and I've talked about this on Freight Economics, is as you come out of a down cycle, bankruptcies actually accelerate. And the reason they accelerate is equipment becomes more valuable, therefore the banks call the notes. Real estate becomes more valuable, therefore people want to liquidate real estate. We saw that with like Central and New England Motor Freight a couple years ago, Yellow even. But also drivers start to hear that other drivers are getting better quality loads. And so what you start to see is a flight to quality for truck drivers with like, hey, I'm at this carrier and I'm seeing Zach show up and he's talking about how many miles he's getting. My carrier is not getting that many miles. It's a problem. And so I think what happens, you have years of really abysmal conditions.
Right.
As the lenders start to put pressure on companies to want to get paid, that's going to accelerate bankruptcies. So we're going to see more and more bankruptcies, even as the market recovers. It always happens. Celadon died at the end of 2019. The market was already coming out of that freight recession. And it died really as we were coming out of it. And that's going to happen again this time.
Yeah, there's always a lag.
So yes, the answer is bankruptcies are going to be just one more factor that's going to cause it. But ultimately, our capacity situation is all a driver issue at this point.
Yeah.
And so as long as the administration, the bet that you're making is that the bet that I think is fair to make is that the administration is not going to ease their approach on this compliance crackdown. Right. And if we see signs that they are easing it, then maybe there's a justification for why the market things should not be tighter. But until that happens, I don't see a case.
Yeah.
Great. Well, it looks like that was all of the time we have for today. I think we had more questions than we've ever had in any state of freight, which is incredible.
The most important state of freight in history. And we have Fleet Owl.
Thank you so much to everyone.
So Fleet Owl people, we want an owl. I want one of those here. Is that like
we're gonna have to get you one.
I love it. It's beautiful. Look at that. I like his colors. Whoever designed that's cool.
Zach and Craig, thank you guys so much. That was such a great state of freight. And to you, our audience, great questions. Hate that we couldn't get to answer them all. FreightWaves is bringing our events to you next month, live in person. We will be in Charlotte, North Carolina on March 3rd for our FreightWaves Roadshow. That is the first stop. So if you're in the local area, I don't think we've sold out our tickets quite yet. So visit roadshow.freightwaves.com. To learn more and mark your calendars for the next State of Freight. We'll be returning Thursday, March 19th at 2 p.m. Eastern. We can't wait for you to join us then. Thanks again, everyone.